And we are back. Welcome. This is Macro Money. I'm Elias Pivak, head of Global Macro here at Tasty Live. And we are going to take a look here at an interesting week ahead as we get a little bit of a change of pace for the financial markets last week. We'll take a look at exactly what that means momentarily. Um, but of course, as we break this down, the key that we are going to have sort of in the back of our mind as a sort of filter on everything that's going on here is why is last week different from this one? And we'll take a look at exactly here at what that seems to imply, uh, because if we take a look at the price action dynamics that we've noted here, they seem to very kind of pointedly give us something that is something of a departure for financial markets here versus what we've seen in recent uh, in recent, let's call it months even, although things have evolved a little bit here and there. But as ever, the key question is, why is it that with key economic data on the docket, CPI, of course, a key input into the conversation that we've been having for quite a few weeks. Why is it that the markets suddenly seem to be losing the critical dynamics that usually, at least let's call it since October of last year, have been in control of what is occurring? And what that means for this week's data, but also really for market sentiment writ large, and whether it signals that something larger, something more eye catching is perhaps afoot. So I'm going to start here with a look at just the performance that we saw last week. And the thing to really focus on here, of course, not the worst kind of week here, not a terrible loss, as it were, for Wall Street. We can see the benchmark S&P 500 here off just 0.3%, but it's the mix of things occurring that seems to really stand out here. So NASDAQ leading the way lower for stocks, down 1.6%. And ostensibly, that's the more kind of yield sensitive of the two. It's the one housing the tech names that have been such a potent driver of momentum for these markets. And despite the decline in yields here, we can see yields fell at the 2-year benchmark. Yields fell at the 10-year benchmark. In fact, they are down for a second consecutive week. And nevertheless, that yield-sensitive NASDAQ is not only not responding, it's actually at the forefront of losses. And so this idea that data is basically a kind of activating function for Fed policy expectations. And if we get something that seems to suggest that the Fed is going to be easier rather than tighter, that we're going to get more rate cuts rather than less, then stocks go up because, of course, cheaper money and more flexibility that comes with cheaper money in businesses that don't necessarily turn a profit. Of course, revolutionary tech businesses and products front and center there, given what's been the catalyst for markets. If that's what's going to power things, then lower yields, you'd think, is good news. But and indeed they have. We've seen that really since the beginning of the massive rally that we've seen in stocks, going back late October, early November, much of that momentum was overseen by the Fed starting to really massage the language, saying we've reached the peak in rates. Okay, now we're thinking about cutting. Okay, now we're thinking about cutting. That was kind of the communication arc that we got from the Fed. Let's call it over the November, December into January meetings. Now, when we quantify what the Fed was saying about how many cuts we were looking at, it was a baseline forecast issued in December calling for 80 basis points in easing. The markets, of course, thought that this was going to be something much more dramatic. And at the turn of the year, we're looking for twice that, as we've discussed extensively before. The markets were, depending on sort of where you look at it, where you take your snapshot, looking at 150 to 160 basis points for easing. So about twice what the Fed envisioned. And what we saw really since the beginning of January up through maybe about mid-February was this narrative where you'd get better than expected U.S. economic data, the number of cuts would diminish, but it stayed greater than that of the Fed. And so you still had this kind of money will be easier than the Fed has acknowledged story powering things higher. And with that, this ability to say, okay, we can keep going up on stocks even as yields rise. Once we got to 80 basis points, though, about 3 weeks ago, that narrative pointedly changed. And we got much more into a world where weaker data was greeted as if to say, oh, ISM numbers came up soft. Good. JOLTS numbers came up soft. Good. All this means that we're going to back away from 80 into a more dovish direction. Let's keep stocks going higher. And so once again, you caught this dynamic where data that was either in line or weaker than expected was being positively received. And last week seems to have marked yet another turn away from this, because on the data front, non-farm payrolls seemingly gave the markets what they needed. Average hourly earnings, a measure of wage inflation, down, weaker than expected. Unemployment rate, higher than expected. A little bit warmer on the headline for job creation, but that one is much more subject to revision, and in any case, only overshot by about 75,000 jobs, which is not the world's biggest margin. So if the markets were to interpret, oh, this means fewer Fed rate cuts now becomes more Fed rate cuts in relative terms, great news, risk on. Well, then we didn't get that dynamic last week for yet another departure. And so what we see is a much more kind of risk-off classic narrative. The usual haven assets, or let's call them anti-risk assets, because there's nothing inherently safe about them. Gold up. The Japanese yen, which tends to move inversely of yields, up. The US dollar, a little bit soggy. The euro here as a benchmark, the 6E contract, the most liquid pairing for the dollar, showing a rise of 0.9%. So the dollar inched down just a bit, but ultimately quite muted. And given the decline in yields, if it were combined with a more dovish shift in Fed policy odds, one might have expected the dollar to lose much more. In fact, that policy outlook is in stasis. We were at 80 basis points last week. We are at 80 basis points still. We were at 80 basis points the 2 weeks prior to that. So ostensibly, this decline in yields, rise in gold, rise in yen, and seemingly out of turn decline in stocks, all that is happening as the Fed outlook is not moving, despite extensive testimony from Fed Chair Powell last week, despite the NFP report. In fact, despite the price action and the data that we've seen come out for 3 weeks' time now. And so we seem to be setting up for a different kind of narrative. And this week, of course, offers a great stress test to see if, in fact, we are going to manage to keep going down this road. And of course, as we mentioned earlier, the focus first and foremost on U.S. inflation data. The CPI expected to give us an unchanged reading at the headline, 3.1% year over year. The core reading seen coming down from 3.9 to 3.7%. That's the one that the Fed cares much more about. It's the one that really captures where inflation still lingers. You can see here it's obvious with the naked eye. Energy at this point is a negative contribution. Goods have become a negative contribution where inflation has completely squeezed out of that part of the equation. Food is still a slight adjustment higher on inflation, but it's shrinking considerably as global food costs decline. So it's really the service sector. The service sector, excluding food and excluding energy, so the core there. And it's in that core measure coming down from 3.9 to 3.7% that we really get that reflection, and we can see that is moving ostensibly in the Fed's direction. So from the looks of it, a non-controversial report here. Now, we have seen that U.S. economic data has turned a little bit soggy relative to forecasts since about mid-February. And as we were just saying, you could probably make the connection here that all through the second half of last year, it was bad data is good because it means more cuts. And you can see here data disappointing relative to expectations. This is a world in which you want more cuts because the economy appears to be weakening. Since the beginning of, at least relative to forecasts, that is, since the beginning of the year, we're going in the opposite direction. The economy is getting better relative to expectations, or the numbers are coming out better relative to expectations. And so you're able to see stocks go up and the rate cut outlook be pulled back as long as you are under 80. But clearly, we are not under 80 the past 3 weeks. And so this dynamic seems to be evolving. Now, if we look at this then and consider that we've had a kind of softening in U.S. economic data outcomes here, then one might conclude that CPI also might be at risk of missing on the downside, if only because analysts' forecasts perhaps have adjusted for whatever this was, and now the bar is higher for data to clear. We saw this last week and indeed over the past several weeks with the latest updates on the economic activity surveys, you can see ISM turning out weaker results than anticipated on both services and manufacturing sector indices, and indeed showing not just worse than expected outcomes, but actually downturns in economic activity. So services growing at a slower rate, down from 53.3 to 52.6. Still growing in that it's over that 50 threshold, but slower. Manufacturing in contraction mode still, and contracting at a faster rate from 1 month to the next in February. So signs of economic slowdown seemingly, and that showing up in signs of the inflation structure getting soggier. So we can see here the inputs tracking costs for services slower, manufacturing slower. You put that with what we're seeing in the overall data, and you get the sense that maybe this CPI number is skewed, at least as far as surprise risk, on the downside. And therein comes the most interesting thing in my mind for markets this week. If CPI misses, that would imply that perhaps there is a clearance here, a kind of permission emerging for the Fed to begin to cut. Now, as it stands, we are still looking at about 80 basis points in cutting. That has not changed. The likelihood that we get a decline in March is negligible. 97% probability of no change is baked into Fed funds futures. As we start to get into May, 80%, still no cut there. As we get to June, though, the situation turns, and there's a 70% chance now in the markets that we get the first cut then. With then a kind of glide path to issuing at least two more over the course of the subsequent 4 meetings in July, September, November, December. Helpfully, the November meeting is after the election, so perhaps you get another cut then in July, then a break in September, and then November and December, if only because the Fed wants to stay away from the electoral cycle, despite having basically pre-announced. But if it's getting to a place here where even a miss on CPI that locks in rate cuts, that gives the Fed the confidence to say, okay, we can move forward now. If that even is unable to lift stocks, then indeed that narrative is priced in already, and a larger liquidation akin to what we've seen last week, where stocks go down with yields, and yen goes up, and gold goes up, and perhaps the US dollar finds its feet in a more generalized, more bifurcated risk on, risk off world. Perhaps that is then where the road ahead is leading. So this should be a very critical point of inflection here, if there is a weak CPI number that stocks then can't make hay of. Also on the docket for the week, we are going to get U.S. retail sales data. That is, of course, going to be another touch point on this. The U.S. consumer, the critical driver of U.S. economic growth, close to 80% of U.S. GDP growth is household consumption. So a very important indicator here. The month-on-month number is the one that's the most eye-catching, typically for markets. It's expected to go up 0.8% after the disappointing 0.8% decline in January, which, by the way, not the seasonal tendency. The kind of mind jumps to the idea that there's holidays spending perhaps in November and December, and then a kind of hangover cool off in January. Well, that's not been the case the past several years, going back to about 2019. So there doesn't seem to be that effect here. It seems to have been a general slowdown. And one thing we don't have on the chart here is the year-on-year rate, which is perhaps even more ominous. The year-on-year rate for retail sales in January was up only 0.6%. That's actually the weakest since retail sales returned to growth after the washout, where we had 3 consecutive months of heavy losses in the second quarter of 2020, of course, right when those COVID lockdowns really closed the entire economy, and not just in the US, but globally. So, of course, consumer spending was crushed. January was the weakest year-on-year reading for retail sales since then. So something appears to be rolling over here. If we get a relatively weaker number on this and a relatively weaker CPI, and stocks still can't rally because it's still not enough to get the Fed juices flowing for speculators, again, an ominous sign. And finally, at the end of the week, we'll get a little bit of a forward-looking view for consumers. This is going to be the University of Michigan Consumer Confidence Survey. We're expected to see steady readings here for the most part. They deteriorated a little bit in the February survey because inflation expectations ticked up from 2.9 to 3%. They're expected to hold steady here, so maybe not a huge influence from this release necessarily, if things hold relatively to expectations. Though, of course, if they do not, and we do get a surprise, then again, it's these same dynamics we'll be looking for. Are markets able to rally on softer data? Because it means looser Fed policy. And if that's a trigger that's stopped working, well, then stock markets may be running out of tricks to hold themselves afloat here, at least in the near term. And that is macro money for today. We're going to delve into all of these things more in depth throughout the week. We're here every Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what happens thereafter. I'm back on with Chris this week for Futures Power Hour on Friday, on with Tom and Victor for First Call on Sunday, writing for the News and Insights portion of tastylive.com, and of course opining on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. See you tomorrow.